Welcome back to the deep dive. So we're kicking things off today with a pretty wild fact from our sources. It turns out the average time a Wall Street investor actually holds onto a stock has shrunk. Well, shrunk dramatically, to the point where holding for just 10 years is now seen as, believe it or not, a virtual eternity. Can you
Yeah,
imagine?
it's pretty incredible when you think about it. 10 years used to be standard long-term thinking.
Exactly. But here's the interesting part for you, the individual investor. That crazy short-term pressure cooker that Wall Street operates in, well, it just doesn't apply to us in the same way.
Right, we don't have those same quarterly performance demands.
And that difference, that freedom, really opens up some unique opportunities for building long-term wealth. We're especially thinking about what we call long-term gems for dividend investors. So today, that's what we're diving into, how you can use that advantage.
Yeah, our mission here is really to pull out the key insights from our sources on three pretty distinct types of high-yield stocks that really deserve a close look right now. And we want to show how each one fits different goals you might have as an investor. Whether you're after, say, super reliable income, or maybe faster dividend growth, or even a turnaround play with a solid history.
Okay, let's dig in. We're looking at the power of long-term dividend investing, which, sometimes gets lost in all the short-term market noise. And we've got these three categories lined up: the reliable high yielders, the dividend growth machines, and these interesting turnaround dividend kings.
Sounds good.
All right, first up, let's talk about a stock one source described in a way I kind of loved. It will put you to sleep, but you'll have good dreams. What company are they talking about there?
Yeah, that's almost certainly Realty Income, ticker O. It's the biggest player in the net lease REIT space, real estate investment trust.
Okay, net lease. Remind us what that means exactly.
Sure. So net lease basically means they own properties, usually single-tenant ones. But the crucial part is the tenant pays for most of the operating costs, things like property taxes, insurance, maintenance.
Okay, so Realty Income mostly just collects the rent.
Pretty much. It makes their income stream incredibly predictable. It's almost like a bond payment.
Yeah.
Takes away a lot of the usual landlord headaches and unexpected costs.
Makes sense. Less variability.
Exactly. Which is why it's often seen as a sort of set it and forget it type holding for conservative folks.
Yeah.
And scale is just huge, over 15,600 properties.
Wow.
Yeah, retail industrial assets spread across North America and Europe. They're a really diversified portfolio.
That is a massive footprint. But, the source also called it a tortoise of a business. Being that big, does that mean growth is just glacial? What are the downsides there?
Well, that's the trade-off, right? You're not going to get explosive, quick growth from a company this size. It takes a lot of deals to really move the needle on revenue and profit.
Right.
But flip that coin. For a long-term investor, that size is actually a massive advantage. It gives them incredible access to capital markets, often at better rates.
Easier to borrow.
Exactly. And they can take on huge deals that smaller competitors just can't touch. Plus, it lets them be an industry consolidator, snapping up smaller portfolios.
So the size equals stability and maybe even lower risk in some ways.
Precisely. And for you, the investor, look at the specifics. You get a dividend yield around 5.6% right now.
Pretty solid.
And it's paid monthly, which, as the source noted, can feel a lot like a paycheck replacement if you're in retirement or need regular income.
Yeah, that monthly payment is attractive.
Plus, it's backed by an investment-grade balance sheet. That's a big confidence booster. Strong financial health. And maybe most importantly, they've raised that dividend every year for 3 decades.
30 years. That's consistency.
It really is. A clear track record.
Okay, so summing up Realty Income. If you're a conservative dividend investor, you value stability, you want that monthly income check, this seems like a really strong contender, something you could genuinely plan to hold for 10 years, maybe much longer.
Absolutely. It's built for that kind of long-term income-focused approach.
All right, let's shift gears. From that stable base, let's talk about growth, a different kind of dividend opportunity. Brookfield Asset Management, ticker BAM, it's Canadian, and our sources highlighted something interesting. Its size, being smaller than some U.S. peers, is actually an opportunity. How so?
Right. BAM. Their business is being an alternative asset manager. Basically, they manage huge pools of money for other people, institutions, pension funds, etc., and earn fees for doing it.
What kind of assets?
Real assets, mostly. Things like renewable power projects, big infrastructure like ports or pipelines, prime real estate, private equity deals.
Okay, tangible stuff.
Exactly. And they're good at it. They actively manage these assets across the globe. Right now, they've got about $550 billion in assets that generate fees for them.
Which sounds like a lot.
It is. But their ambition is even bigger. They have a publicly stated goal to hit $1.1 trillion by the end of the decade.
Double the current amount. That's
Yeah.
aggressive.
Very. But that's where the opportunity lies, especially because they're starting from a slightly smaller base than some U.S. giants. More room to grow, potentially faster growth.
And you mentioned they operate across several areas: renewables, infrastructure, real estate. Does that diversification help them hit that target?
Absolutely. It gives them multiple levers for growth. If real estate slows down, maybe infrastructure picks up, or renewables take off, it spreads the risk and opportunity.
Okay, so the business model is growth-oriented, but what about the dividend specifically?
Yes. That's the real headline for dividend investors here. The current yield is about 3.1%, which is already quite good compared to the broader market like the S&P 500's 1.2%.
Decent starting point.
But the growth is the kicker. Their last dividend increase was a massive 15%.
15%, that's huge.
It is. And management hasn't just said this was a one-off. They believe they can keep up that rate of dividend growth, around 15% through the end of the decade.
Wow. So what does that actually mean for your income stream if you invest?
Well, think about the power of compounding at 15% a year.
Yeah.
Your dividend income could actually double in roughly 5 years.
A double in 5 years.
Yeah. It means a potentially huge increase in the actual cash you collect, much faster than you'd get from a slower-growing dividend stock. Your income stream could really accelerate.
Okay, so this isn't just for pure dividend growth investors then. It sounds like it could fit nicely for growth and income investors too.
Exactly. You get that rising income stream, plus the potential for the stock price itself to appreciate as the business grows so rapidly. It ticks both boxes.
Fascinating. Okay, that's BAM. Now for our third one, which is a totally different angle. Target. Ticker TGT. We all know Target, massive U.S. retailer, always competing with Walmart.
Right. And what's really interesting about Target, especially now, is its dividend history. It often gets overlooked. They have raised their dividend for 58 consecutive years.
58?
58. That makes them a dividend king, which is a very, very elite group.
Dividend king. That means 50-plus years of increases, right?
Correct. It signals an incredibly durable business model, one that's navigated decades of economic cycles, recessions, changing consumer tastes, everything. And just for context, Target's streak is actually 6 years longer than Walmart's.
Huh. Didn't know that. But okay, let's tackle the obvious issue. As our sources point out, Target's yield is quite high right now, around 4.6%. And that's largely because, well, their current store concept maybe isn't clicking perfectly with consumers today. Walmart's low prices seem to be winning out over Target's slightly more upscale approach at the moment.
That's the current narrative, yes. It's facing headwinds.
So how does that dividend king status square with the current struggles? Why isn't it just another struggling retailer?
That's the key question. The dividend king status tells you this isn't just any retailer having a tough patch. Retail is cyclical. Trends, as the source said, wax and wane. Consumer preferences shift.
Sure, happens all the time.
But nearly 6 decades of uninterrupted dividend growth suggests Target has a kind of built-in resilience, a proven ability to adapt and figure things out. They've been through tough times before and always found a way to pivot and reconnect with shoppers.
So history suggests they'll likely turn it around again.
History provides a strong argument for it, yes. And it's not just hope. They've recently shaken up their management team specifically to drive a turnaround. Now, given how big Target is, this won't happen overnight. A turnaround takes time, so you definitely need a long-term mindset here.
Right. Patience required.
Definitely.
But if you're maybe a more aggressive investor or someone who likes finding value when others are pessimistic, that 4.6% yield sounds pretty nice while you wait, doesn't it?
Exactly. You get paid quite well to be patient. And because it's a dividend king, you can still reasonably expect those annual dividend increases to continue even during the turnaround.
So patience gets rewarded with a high starting yield and continued growth. Interesting proposition for the right kind of investor.
For sure. It's a contrarian play, but one backed by an incredible long-term track record.
Okay, let's pull these three together then. What does this mean for you, the listener? We've got Realty income, the big, stable REIT. That seems perfect for income seekers wanting that reliable monthly check. Predictability is key there.
Rock solid income.
Then Brookfield Asset Management. Bam! That's the growth engine, aimed squarely at dividend growth investors or growth at income folks who want that potential for their income stream to really accelerate over time.
Yeah, targeting that big 15% growth rate.
And finally, Target, the dividend king turnaround. A
Ah,
different beast entirely. Maybe for more aggressive or value-oriented investors willing to be patient, collecting a high yield while waiting for the business to regain its footing.
Right. Three very different companies, three different ways to approach dividend investing for the long haul. And I think the crucial takeaway through all this for you is remembering your advantage as an individual investor. You don't have Wall Street's short-term pressures.
Yeah.
You can hold for 10 years, 20 years, let these strategies compound and work for you.
Mm-hmm. Use that time horizon.
That's your edge. Let the power of long-term holding and compounding really build wealth in your portfolio.
Absolutely. So these aren't just stock picks. They're really examples, right? Examples of how digging into different business models, different dividend strategies can uncover really diverse opportunities. Opportunities for long-term income, long-term growth, especially when you use that individual investor advantage against all the short-term market noise.
Well said. And it makes you wonder, doesn't it? Given how short Wall Street's holding periods have become, what other advantages can you find just by consistently taking that multi-decade view? And maybe what other sort of boring but reliable industries out there might be hiding the next realty income or even the next dividend king, just waiting for a patient investor like you?